Hello and welcome to Yadnya Investment Academy. Today we are going to do a mutual fund review. Let me first explain the methodology of the review. We will list and review the fund on various parameters and rate each parameter by green, yellow or red star. Green star means good performance, yellow star means average performance and red means below average performance. In the end, based on total number of green, yellow and red star, you can take a call to buy this fund or not. Please remember, all the fund parameters we are going to discuss here are based on 14 September 2017 data as reference, and we only review regular and growth plans of mutual funds. Before we start the review, we want to inform you that we have come up with our first book, which is on mutual funds and SIP. Book is available on Amazon, Flipkart and other channels. Link is mentioned in the description of this video. In this video, we are going to review fund name HDFC Prudence Fund, which is an equity-oriented fund launched in 1994. Before going into review, let's understand about fund's objectives. Fund invests in mix of equity stocks and debt instruments and is a fund which gives long-term capital appreciation with some cushion of debt income. Fund mostly have equity exposure between 65 to 75% and rest in debt. Now let's start the detailed review on each parameter. First, the fund belongs to HDFC Mutual Fund family, which is currently India's second biggest fund house in terms of asset under management out of more than 40 fund houses and was established in year 2000. So for being a very large and experienced fund house, we give a green star here. Prudence Fund was launched in February 1994, which at that time was part of Zurich India Mutual Fund and was merged with HDFC in year 2003. This means this fund is active for more than 20 years now. Hence definitely deserves a green star. Fund is categorized in balanced category or equity oriented hybrid fund category. Balanced funds are those hybrid funds which invest 60 to 80% of their portfolio in equity and rest in debt. Currently its equity allocation is around 75% and rest is in debt. Now moving to next, this fund has a very large asset under management of close to 30,000 crore rupees. And is the largest, not just balanced fund, but the largest equity oriented mutual fund in India. Growth in funds asset under management has been very rapid in last few months, especially after they started monthly dividend plan, and it has grown from rupees 15,000 crore to rupees 30,000 crore in only 19 months. While higher returns by the fund has been a draw for investors, scheme's assets saw a spike after it started offering a monthly dividend payout option since January 2016. Since then, the fund has been paying a dividend of rupees 0.3 monthly, which on a face value of rupees 10 translates into a yield of 12% per annum. Fund houses can pay regular dividends only out of distributed surplus. All is good since markets are touching new heights. But investors who depend on balanced funds for regular dividends may be caught on the wrong foot if the equity market changes direction for some time. So on this parameter, we give this fund a green star for being a very popular fund. Now let's talk about the Moolaha, that is the returns. We will first talk about the trailing returns from 14 September date and then talk about the calendar returns. Benchmark of fund is CRISIL Balanced Fund Aggressive Index. CRISIL doesn't share the data of this index, hence we will not be able to compare the fund with this benchmark. Instead, we have taken Nifty 50 as benchmark, which also happens to be additional benchmark of the fund. We know it is not entirely fair to compare a balanced fund performance with complete equity benchmark. Still, it is a good indicator of the performance. In trailing returns, we can see fund has consistently beaten its additional benchmark index, that is Nifty 50, as well as balanced category average across 1, 5 and 10 years. Its 10 years trailing return performance is actually among the top 5 in the category. Only in 3 years trailing return, fund's performance has been behind category by a small percentage. Trailing return performance shows very good fund performance where it has comfortably beaten even a pure equity benchmark. Now looking at calendarized return of last 10 years, that is from 2007 to 2016, which means returns from 1st Jan to 31st December of a calendar year, we see that fund had 3 below average performance years in 2007, 2013 and 2015, where it was beaten by both benchmark and category average. But there are few very good performance years as well, that is in 2009, 2010, 2014 and 2016. Fund has beaten both additional benchmark and category average 7 times out of 10 with good performance during bad market years as well. So overall trailing return and calendar return performance is pretty good, and therefore it deserves a 2 green star on this parameter. Next important parameter is fund manager. Fund is blessed to have a star fund manager Prashant Jain as its leader since beginning in 1994. He is BTech from IIT Kanpur and MBA from IIM Bangalore plus a CFA. He was working for Zurich Mutual Fund since early 1990s and went into HDFC after they acquired Zurich's India's business. Prashant is also a CIO of HDFC Mutual Fund today and is one of the most celebrated fund manager in the industry. Prashant also manages HDFC Equity Fund since 2003 and HDFC Top 200 Fund since 2002. Both are very popular multi-cap fund and large cap fund respectively with more than 20,000 crore and 15,000 crore asset under management respectively. Both these funds are very good performers and have given overall very consistent returns. We trust Prashant's methods and his approach and research, and actually name Prashant Jain should be enough to give this parameter a green star. Next parameter is to understand fund's equity diversification. Starting with stock diversification, as on 14 September, fund has 97 stocks in portfolio with top 5 contributing whopping 30.8% of total portfolio. Fund has good diversification in portfolio, but weightage of top 5 companies is much higher than our balanced fund benchmark of 16%. Now looking at sector diversification, top 3 sector contributes close to 44% of overall portfolio, and it shows higher allocation to financial sector. So equity diversification of this fund is actually very skewed to top companies and sectors and hence deserve a red star. Now let's understand fund's debt credit quality. Looking at this table clearly shows that this fund carries very high credit quality of debt instruments, only with 1% allocation to debt instruments with less than AA rating, hence deserves a green star on this parameter. Next are expenses. Expense ratio of this fund is 2.26%, which is little higher than average expense ratio of this category, that is 2.2%. Exit load of the fund is 1% if more than 15% of investment is redeemed in first 365 days of investment. Looking at the asset under management it has, and having an expense ratio above average is not good, and therefore we give this parameter a red star. Now those who like numbers, let's discuss few important ratios too for both equity and debt. Let's first discuss equity. Standard deviation, a measure of volatility and risk, is much higher than the category, but actually similar to pure equity additional benchmark Nifty 50, which means it is a high risk taking fund given the balanced nature of the fund. Alpha, which measures the risk adjusted returns. So by taking much higher category risk, it has lower alpha, that is a return potential, than the category. So this means this fund is high risk and moderately low return profile fund. Last is PE ratio of the portfolio, that is 21.1 and is lower than benchmark PE of 25.3, which shows the return potential the fund has. So from equity perspective, fund is high risk and moderately low return fund with good P ratio. Now let's discuss few debt indicators too. Fund has above average year to maturity, that is YTM, of 8.06%, which means expected returns if you hold this debt portfolio till maturity. Average maturity of the portfolio is again on the higher side, that is 8.18 years, which shows fund mostly holds papers with higher maturity, which means it is taking higher interest rate risk. Same is reflected in modified duration of the fund, which is much higher than average, which again shows higher interest rate risk fund is taking compared to category. So from debt perspective, it is moderately high risk fund, but is giving above average returns as well. So overall from risk perspective, fund has bad equity risk profile but average debt risk profile. So we give this parameter a red star. Few other important info to note about the fund is that fund has high allocation to mid and small caps, that is around 24%. This chart here shows that portion of the fund which has higher allocation to corporate securities than government securities. And this table here shows how rupees 10,000 SIP would have performed in various time frames and prove a very good performance and amazing returns this fund has given continuously. So if we calculate, we got total 7 green stars and 3 red stars, with high risk fund is taking being a major area of concern. Kind of risk this fund takes, it should be actually a part of pure equity fund category than balanced category. To summarize, HDFC Prudence Fund is the largest balanced fund in the country. It has been managed single-handedly by Prashant Jain for 23 years, that is since its inception. It has given returns of 19.4% per annum since its inception. Fund has given very good performance by consistently beating its category average and Nifty 50 index. On an average, the fund has higher equity exposure compared to its peers and hence is meant for aggressive investors in balanced category. It adopts a multi-cap approach with a mix of large and mid-cap stocks. Fund manager has positioned the portfolio to benefit from an economic recovery and is bullish on corporate banks, making it a good choice for investors with a 5-year plus time frame. One important point to note, please do not invest in the fund from monthly income perspective, as the monthly income is not guaranteed. Fund has given good monthly returns till now due to good market condition, but it is not guaranteed in the future.